Hey guys, Tara Ryan here with Fairway Mortgage, and today's tip is about mortgage interest rates. And specifically, I want to talk to you about what's going on in the news today because it's big news. The Federal Reserve is publishing the meeting minutes from the Federal Open Market Committee. And that committee is a 12-person rotating committee. They meet 8 times through the year at pre-scheduled times, and during emergency times, they meet additionally as well. One of the main purposes of that committee is to set what's known as the federal funds rate, and that interest rate is the rate at which banks can lend money to each other. It also has a direct correlation on the prime rate, and the prime rate is what sets interest rates on things like car loans, credit cards, and even home equity lines of credit. Okay, so it has a major impact on the economy, and basically everybody's waiting to hear what they're going to say as far as the future of the federal funds rate. However, what I want you to know is that federal funds rate does not have a direct correlation on mortgage interest rates. In fact, the difference between the federal funds rate and the mortgage interest rates has varied, over the last several years between 0.5% and 5.5%. Okay, so not a direct correlation at all. However, it does impact what mortgage interest rates will likely do today. Today will likely be very volatile as we wait and see what they're going to release. But the reason it has an impact is because mortgage interest rates are set by Wall Street, not by the Federal Reserve. And basically it has to do with where the big money goes. So here's the key. The more positive the Federal Reserve is about the economy, the more positive things they say about the economy, the more people are optimistic about the future, and they want to buy stocks. They want to buy a part of that future. As that money moves into stocks, that's less money that can go into bonds, and mortgage rates are actually set by something called a mortgage-backed security, which is a type of bond, okay? So as good news in the economy, more people buy stocks, that's bad news for interest rates, generally higher interest rates. The opposite is true as well. If they're pessimistic about the economy, when they come out with negative comments, that pulls money out of stocks, drives it into bonds, and we end up with better interest rates. We are at a fantastic place with interest rates right now. There's been a lot of global turmoil, and that has driven a lot of people to buy more U.S. Treasuries and our bonds, which has been good for interest rates. We're at a low for the calendar year, and in fact, you can buy 9% more house in December than you could in January because of that drop in interest rates. Okay, so the time is fantastic. I hope you're still out looking for homes. We'll all keep an eye on exactly what the Fed says today, and you can count on me to keep you updated as we go. Let me know if you have any questions specific to your situation. Happy house hunting.